Well, Cashbuild seems to be weathering the current tough economic climate quite nicely, and reining in on costs has acted as one of its buffers, with operating expenses contained at 11%. Operating profit jumped 30% to 464.5 million rand, while revenue climbed 13% and headline earnings per share came in 34% higher. CEO Werner de Jager joins me in studio now to take a closer look at the numbers released today. Werner, thanks so much for your time. So as I said, you've attributed your rise in profits to getting a handle on operating costs. What exactly are you reining in on? Is it fat? And how much more to go before you're sitting pretty close to the bone?
No, there's always fat in a big organization, but when we look at it, how we've approached it, we manage it on an exception basis. So we look at the worst 20 of every category. So, and there'll always be the worst 20. So we keep on cutting at the lower end, the guys that's not performing at the optimal level. And there's obviously every year one wants to think that you've done a good job on containing costs, and a 5% when you look at a comparable growth is a real excellent performance on cost control. The rest comes from new stores. So it'll be a hard task, but again, we've set ourselves the same goal this year.
That all happening in what kind of operating environment? Because revenue was up 13%, but the 24 new outlets added 5% off that. So give us your sense of the market you're catering to right now and the pressure those consumers are under, and how you're staying resilient.
You know, that end of the market seems to be very resilient. Our transactions have increased. We've seen a good basket increase as well in our business. You know, so at our end of the market, the guys seem to be improving their houses, and it seems like the renovation market is quite strong. Typical categories that's in that space did well for us this year. So it seems like there's still a lot of activity at that end of the market.
Exactly how big is that market you're catering to, you know, when it comes to the Bakkie Builders market? We know that you've pursued, 11 Cashbuild DIY pilot stores as well, and that implies that there's still quite a bit more room for penetration.
Yeah, for sure. We've on the big Cashbuild stores, we believe we can get to a 300 store base. We're currently on 223. And that means that there's still a lot of opportunity for growth from that side of our business.
Influencing your strategy, but more importantly, your pricing and your margins, how so?
You know, we've got a very unique way of doing it and managing it, so we keep ourselves competitive in the market. We're not trying to be a specials company that's got weekend specials and do crazy deals on certain days. We've got an everyday lowest pricing, and you know, outside in the field, they're responsible for the selling prices, and back at the support center, the guys must maintain the margin by looking at the different categories. When
it comes to those margins, I mean, you've got margins with selling price inflation of 2%. Just how sustainable is that, given that you know, you've already reined in on costs quite extensively, and you've got rising costs, one would assume, starting to impact?
On the top line side, the inflation of 2% is a Cashbuild specific inflation. So we look at our basket, and cement prices hasn't gone up during this last year, so that's 25% of our business. So it gives you a bit of a perspective on our basket. So how sustainable it is, obviously pressures from the rand coming through. And but our policy has always been to pass through all of those costs to the consumers. We don't take the costs ourselves if there's increase from our suppliers. But we will stay competitively priced at the end of the day. You know, the market must allow you to pass it through.
Having said that, you've got quite a bit of a risk to start factoring into the equation as well. You've got the unemployment levels sitting where they are, strike action, socio-political unrest. One assumes all coming to bear on the business and the kind of market you're catering to right now.
Yes, and specifically where our stores are located. You know, we've got, leading up to the elections in 2016, we typically see a spike in service protests, and that's typically around our stores. So that's definitely something that we are concerned about, but you know, we can't really do much about it.
Exactly, beyond your control.
It's beyond our control, but you know, the first thing is we need to make sure our staff is safe and our people is safe. So that's going to be the overwhelming driver for us, is we'll make sure our staff is safe, and we'll take each day on that as it comes.
As you say, it's really hard to buffer against risks like that. Let's talk through some of the competition you're facing in the market at this stage. How are you viewing that?
Yeah, you know, there's some consolidation that's happening. We saw recently Steinbolt and Iliad joining forces. So, but it's always been a very competitive environment. There's over 3,000 independents out there, and we manage our business on a micro level. So we look at each and every single store, and we look at the competitors for that store. So we're not trying to follow any national strategy in terms of that. And it's working for us, and so we will continue that strategy.
You've also triggered a slight shift in your strategy overall when it comes to the way you're targeting expansion moving forward, moving from purely organic to acquisitive based. And I allude to the P&L hardware acquisition you've made for 350 million rand. Is acquisitive growth now the way to go?
Yeah, we've changed our strategy 2 years ago, and it's taken us quite a while to do the first acquisition. It is still part of our strategy. It will be something that we will pursue in the near future. But for now, this is our first one, and we want to bed it down and make sure that we get through all the regulatory hurdles and bed it down before we will look at anything else.
Werner, how long to go before you bed things down on this front and extract those synergistic merits?
We expect that by end of November we would get all the approvals we require for the transaction. It's estimate at this stage. So hopefully from let's say from the new calendar year we'll see that adding benefits to the business.
Is this acquisitive strategy one that you're pursuing when it comes to targeting business growth outside of South Africa's borders on the rest of the continent? Because one would assume that it is a less risky approach venturing into Africa.
Yes, it is an option, but currently we are expanding into Zambia, so we've registered our company, and that will be a greenfields operation. But there's still other players in other territories that we might enter through an acquisition.
How rife are those opportunities?
They're few and far between, so there's not many groupings as such in the countries. We still need to go into the likes of Zimbabwe and that. So it'll make it a bit more difficult. That's why we've opted for the greenfields approach in Zambia.
Let's leave it there. Thanks so much, Werner, for your time today. Of course, Werner Diache is CEO at Cashbuild.